Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here's some of the trends we're going to be diving into. It's the last trading day of the week, and Wall Street ended stronger. President Trump tried to calm jitters over U.S.-China trade tensions. At the end of the session, all major indices did end the day higher. CEOs are on edge about U.S.-China trade relations and their business operations, and now there's data to quantify that. We're speaking with an expert on what's keeping executives up at night in this climate. And the upcoming holiday season looks to be a prosperous one. One survey finding Americans will be opening up their wallets and spending more than $1.5 trillion. We're digging into where that money is going. Well, the holiday shopping season is shaping up stronger than many had feared. That's according to the International Council of Shopping Centers. The group expects to see retail sales climb roughly 4%, topping $1.7 trillion. The president and CEO of ICSC and host of the podcast From Where I Sit, Tom McGee, is here with more. Tom, it is good to see you. So let's get right to this holiday shopping season outlook here. So forecasting roughly 4% rise in retail sales, Tom, topping $1.7 trillion. What categories, Tom, do you think might benefit from all that? Would you expect toys, apparel? Where's it all going to flow, Tom?
Yeah, I think, well, first of all, great to be with you. As you said, our expectation is 3.5% to 4% growth. I think in regards to categories, I think the ones that you listed are the right ones. I think in regards to where, discount department stores will lead the way. Department stores in general, mass merchants, Amazon, Walmart, et cetera. I will say that one thing that 3.5%, 4% is fairly consistent with what retail sales have done year to date. And the 1.7 trillion is really fourth quarter retail sales. I think underlying this is a continued consumer that is price sensitive and concerned around pricing. But we expect the resiliency that we've seen from the consumer over this past couple of years to continue in this holiday season.
All right, so resilient but price sensitive. What about this shift you guys also call out to activities and experiences? So I'm guessing that's concerts, that's probably travel, right, Tom? That's an interesting theme. What does that indicate about the consumer?
Yeah, I think it indicates, one, I think consumers in general have leaned a lot more into experience. It also includes going out to eat. And going out to entertainment and so forth. I think during the holidays, traditions tend to be important. People gathering around a table, and so I think because of that price sensitivity, I think more people are going to do things like that this year and really make their investment in those things that create a memory as opposed to just a product. People continue to shop and continue to buy products for sure, but I do think you're going to see more emphasis upon those holiday traditions that have become part of a family's ecosystem for a period of time.
And Tom, it's interesting, tariffs do come up as well in this survey. I see that getting a call out here. How do you see that policy dynamic sort of impacting, shaping consumer behavior and attitudes?
Yeah, it's actually quite interesting. All of us, haven't seen the impact of tariffs as directly as we would have expected in pricing. But the consumer is quite concerned around tariffs, and they have a perception that prices have continued to increase, and so as a result, they are very price sensitive. But how that's going to manifest itself is in a number of ways. They're going to look for deals first and foremost. They're going to be very opportunistic, and when they buy things, so that's one of the reasons we look at the holiday over the whole fourth quarter. Because people are already shopping for the holiday. And when they see a deal and they see what they want, they're going to buy it now under the risk that maybe the price will be higher later in the holiday season. And they're very purposeful about looking at retailers and saying, is this a brand that's trying to take advantage of a situation and maybe being too aggressive on pricing? And if that's the case, they'll avoid that brand and go to a different brand or a different retailer that they think is being more true to what the true value of the product is.
I'm curious, Tom, what about AI? It's obviously a mega theme for investors. We talk about it every day on this show. Did that come up in the survey? Did folks tell you they're using AI tools when hunting around for deals, for gifts?
Yeah, no, it's a great point. They did. Not a majority, but about a quarter of the respondents indicated that they plan to use some AI tool to do investigation and research around pricing, around products, around reliability, around reviews, et cetera, as opposed to just doing a traditional internet search. They are using AI tools more purposefully, and I think that will continue.
I'm curious on how confident you are all in this forecast. I only asked, Tom, because labor market's cooling, you got trade tensions, we've got tariffs. There's a lot of moving parts here.
Yeah. Well, I would share your concern that, look, this is a snapshot at a particular point in time. Any of the things that you mentioned could change. What actually happens during the holiday season. The consumer is jittery. I mean, they're concerned. And if there was something that dramatically impacted the employment market, for example, I think that is one of the reasons consumers have been resilient, because the unemployment rate has continued to be at historic lows. And historically, if you look at retail sales, as long as the employment market's strong, retail sales are strong. If something was to significantly impact employment, then I think that would be a different picture. Or if there was some type of large geopolitical event as well. But as it stands right now, I think the expectation would be the consumer would continue to be resilient. But there are risks out there, and there's no denying that.
Tom, great to have you on the show today. Thank you.
Thank you. Great to be with you.
The major indexes notch weekly wins after a volatile week. Here with the trade day takeaways, Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. What bank scare? That is number one here. Let's just skip to the regionals. You can call it a dead cat bounce, and fair enough. This is the green board. This is the regional banks, by the way. And fair enough. If you look at a 2-day view, there's a lot of losses to make up. But I'm going to show you some other markets. By the way, let's just switch over to a 5-day. You see a little bit of green in there. But let's get back to China, because if we dial back 1 week, that was the source of all the hiccups that we had last Friday. And Monday, we came roaring back. And so this is the week in China. Ended up pretty green. Now I'm going to switch to the U.S. This is a 5-day look. Every single sector in the green, financials just barely, like 0.001%, but I think investors will take that. Real estate, curiously, up 3.3%. That was a lead. And let's take a look at the leading stocks here, or leading ETFs. And I got Korea, that is up almost 10%. That's a chip play. You got stocks doing well, emerging markets, home builders, retail, everything doing pretty good. Not crypto, not IPOs, not regional banks, and ARK. So there were a few stumbling blocks, and we can call that the fringier part of the market. IPOs, classically kind of fringy. But here's what the Dow did over this past week, 1.5%, NASDAQ up 2%. Even the Russell 2000, which was down today, that was up 2.4% for the week. Now, one of the things I'm still looking at is volatility. And after that bank scare yesterday, we had a huge rise in the VIX. We got to about, overnight, it opened up at about 27, 28, and it opens up around the time Europe wakes up, or it starts trading around 2 or 3 a.m. Eastern. Came back down to 20, but that's still elevated. And you're going to see never really cracked 20 meaningfully throughout the week. So going into next week, we are still primed, and we could see more market scares cause additional hiccups in the market, but we got to wait for those headlines, and maybe they don't come. So notwithstanding that pretty solid week, 10-year ends right around 4.01% after dipping below that yesterday. So I'm not going to say it's all clear, but things definitely turned up, and it's a lot better than it could have been.
What about those surging metals, my friend?
Yes. So on the open today, I think gold and silver, they both hit record intraday highs, but silver is engulfed. What is that? That's in a bearish engulfing candlestick. And I'm going to show you a few examples here. And it's across the metals complex, not copper critically. But let me just show you. Here's a 5-day view. Let me do you one better. Here's the intraday. The biggest loser today is palladium. Let's just check that out. That's down 10%. I'm going to show you a 1 month with candlesticks here. And you can see some kind of spotty price action. But here is today, that big red candle. And let's go over to silver, down 5%. That is your bearish engulfing right there. Completely engulfs this bullish candle that we had there yesterday. That is a big warning sign. Then we have gold. Let's see, GC equals F. There we go. Thank you, sir. And that's not quite the bearish engulfing. Nevertheless, I have a technical indicator called the Levine Top Finder, Bottom Finder. I use the Top Finder on gold, and it says this move is on pause right now. So we'll have to see. anything can happen with a parabolic market, but my indicators are saying, well, this thing is probably thrown in the towel, at least for a little bit, needs to pause.
That's gold. What about digital gold?
We will check that out as well. So one day after I outlined the bullish seasonality call on Bitcoin, guess what? It fell today again. So, and it is below my trading range. Let me just pull this up here and I will show you. I think it hit 103, 104,000. Here's a 3-month view. And we got some candlesticks there. Let me put a line so you can, there's the line chart. You can see that a little easier. So now it has decisively broken this trading range. And that was kind of a critical one. I wanted to see 105 hold. It did kind of on a closing basis, because if you consider 5 p.m. Eastern, the close for that, but it really did go farther than I would like. Over the weekend, I want to see it pop back above 110,000, and I'll tell you what, 115 is a huge area. The shorts are going to be defending it, and so you're going to want to see this climb above 115 next week. If you see a sell-off from 115 or thereabouts, that is another bearish indicator. We're probably heading back down to test 100,000.
Speaking of next week,
yes.
What's on your radar?
Well, we got CPI next Friday, so that's going to be front and center. I'm going to be scanning for credit headlines. We still got the regional banks reporting earnings. Any more hiccups there? Any more fraud? Rates and volatility. That's on my calendar.
Thank you, buddy.
You bet.
Appreciate it. Stick around. Much more Ask for a Trend still to come. In an uncertain business environment, leaders are grappling with a constantly changing policy landscape, particularly around tariffs. CEO confidence is dipping, according to recent data. My colleague Alec Canal sat down with Robert Glazer, Acceleration Partners CEO, to discuss.
From where you sit, what's really driving some of this pessimism?
I think there's a lot of uncertainty, as you said. There's a lot of back and forth and whack-a-mole, and we still have some hangover from COVID. I think the ups, the downs, the left, the right, the too much inventory, not enough inventory. So I think it's been hard for people to get a steady state, and that makes decision-making hard.
And we have heard before that it's more so the unknowns that are the issue. It's better to just know everything that's going to happen. And as we've seen on the trade front, we don't necessarily even know what tariffs we're going to be putting on China at this point. So how much of that is a factor too? Yeah,
I think markets do not like unknowns. Everyone has a game plan A, a game plan B, and a game plan C, and that's just multivariant decision making, which makes anything harder.
And the Fed releasing its beige book and noted that layoffs are picking up, some tied to softer demand, others to AI investments reducing headcount. How are leaders striking that balance between efficiency and employee morale right now and making sure that they're not leaning into increased layoffs? Because you talked about PTSD from COVID, and that was something that I think business leaders today go back to, because it's really hard to hire those workers back.
Yeah, and I think they're having a hard time, and this gets to the root of kind of understanding like what you value and how do you feel about a decision in a day, in a week, and in a year. There's a lot of pressure in this 24-hour news world we're in. Like, what's your answer today? What's your decision today? And you see people, as you said, laying off because of AI and then hiring them back and more chaos. So I think if people kind of slowed down a little bit and didn't try to win the day and maybe thought about how do I win the week or the month or ideally the next couple years.
And how should CEOs be approaching that and doing that, especially since we are in the early innings of AI?
Look, I think you need to be clear about what it is that you value personally and in your company, and how does AI work itself into that? You know, you can't say we value X, Y, Z and people and their contributions and then automate everything. That just isn't consistent with what they're saying. So when I think about some CEOs that have made difficult decisions, they're decisions that like everyone said would cost them in the short run, and they were better in the long run.
And talking about better in the long run, one trend that I've noticed across industries, so we look at Comcast, look at Oracle, Spotify, is this dual CEO structure. Not just one leader, but two leaders. What are the pros and cons of that approach?
Look, I think the job of a global CEO now is almost too big, right? It's a 24/7 job, and you have to be in these places, and so just the nature of it, not as many people maybe even want that job, as crazy as it sounds. So I can see how people want to break these up. I think it's really hard when you start splitting accountability for the most important job. I remember coaches usually say you could have a person in two boxes, but not two people in one. I think the people in the organization are looking to a single person to answer. So I don't know. I would more see how to break that up in terms of a European CEO or a US CEO.
Clear
or
and
president.
obvious.
Clear and obvious distinctions. Like who am I talking to and who is the last word on
Yeah,
this?
and it does seem like, to a certain extent, those dual CEO structures, that is happening, right? For example, with Netflix, you have Greg Peters, who is firmly focused on the product side. Ted Sarandos is more on the content side. So it seems to be like more clarity over everything is important for leaders and also those who work under those companies.
I'm just curious if those companies have a crisis, who are people calling? And who are they looking for an answer to, right? It seems like those titles are almost maybe a little bit different, but it's tricky. And again, but these are hard jobs. Yeah.
And just being in this industry, talking to the executives that you've spoken with, I guess, how have the issues that companies face changed over the years? And maybe how has the role of the CEO changed?
I think it is this 24/7 always on global. I think that's how it's changed. And I think it is the expectation that there is a response today, right? And a lot of times the answer today is really not the best answer, the right answer. It's hard to say, you know what, we don't know, we don't have all the information, we're gonna dig into that and make a better decision when everyone's kind of asking you for what's going on right now.
And your company, marketing consulting, right?
Yeah.
Like, so we typically hear when there's an economic slowdown or a recession, marketing budgets first to go. What are you seeing when it comes to marketing spend and how businesses are allocating their capital?
Yeah, marketing has had a tough couple years, and people are being more discerning. There's less venture capital, there's less money out there. People want to know where their money's going, how it's being spent. So there's definitely more belt tightening than there was a few years ago. But that forces you to sharpen your pens and make sure you're doing a good job. And it tends to favor the stronger players.
Okay, so you are seeing evidence of sort of that pullback or that just more cautious approach when it comes to allocation.
There is definitely not money being thrown around like it was pre-COVID.
That is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.